and we've seen that spread tighten, and basically the spread is non-existent right now. And so I think buyers are valuing these institutional assets very similar to how they'd value multifamily.
I think there's more deals being made on the stabilized front than there was last year, but there's still a lot of deals going to market that ultimately don't transact and trade. But what's been pretty active over the last year in the built-to-rent sector has been more of the forward purchase deals. And I think that's just because a lot of the institutional capital is more, I don't know if I want to call it opportunistic, but they're looking for, north of a 6 yield on cost. And maybe a couple of years ago that was a 7, but they've, come down a little bit. And so a lot of these national regional home builders can build cheap enough to be able to deliver at a price point that makes sense for those investors to get their 6% untrended yield on cost or whatever they're after and take on that lease up risk. And even more specifically, it seems like on the forward purchase side, the towns have been kind of the bread and butter, I think, for a lot, just because I guess they can, the square footage is maybe a little bit smaller, they can build them cheaper. And then they're, like you said, they're in high demand on the rental side. So it's easier to make those yields make sense. So I think there's been quite a bit of demand for townhomes as well.
Absolutely.